We're going to cover the number one reason why most people lose money in the stock market. It'll seem pretty obvious after I explain everything to you, but I have to walk you through the steps of what everything means, because I guarantee you if you're a new investor, you're probably going to make this mistake. I personally made this mistake too, so here we go. So we're going to start right here on this chart. It's a chart of the S&P 500 since 1928. So you can see right here, there's a big crash in 1929. We had World War II, Cuban Missile Crisis, Vietnam War, Black Monday. We had a financial crisis, a tech bubble, a housing bubble. We had a pandemic. We had all this crazy stuff happen, and many people were screaming that the market is going to be done. It's never going to recover. It's going to be the lost decade. Get out of the market, put your money in cash, put your money in bonds. Now, I'm not going to lie. Some of those time periods, if you would have put your money in cash or bonds, you would have did a lot better than being in the stock market. But there's a huge problem with that. So I'm going to show you this chart real quick. So this is the S&P 500 chart from 2011 until 2017. All of these dips that happened, this is all the headlines of the news articles that came out, and a lot of the news articles were wrote by pretty famous investors. So we're just going to read through a couple of them. So this guy predicts a 50% unemployment and a 90% stock market crash and 100% annual inflation starting in 2014. Did that ever happen? No. So Tom DeMark, after this little dip right here, he said it looks like 1929 parallel and warns of a crash. It is preordained. He is saying that the stock market is going to crash 80% like it crashed in 1929. Imagine if you listened to him. Look at all this upside that you would have missed on if you would have listened to this guy or any of these people right here. And this chart only goes until 2017. So I'm going to zoom out. So I'm going to go from 2017 to current. So all of these news articles right here, if you would have listened to any of these people right here and you would have sold right here, maybe the market dipped, you would have sold. Maybe this dip happened, you would have sold on this dip. Any of these dips, if you would have sold on any of them, look at what you would have missed out on. So 2017, the S&P 500 was $217 a share. Right now, it's almost $500 a share. So if you would have listened to any of those people, you would have gotten smoked. You would have missed out on 150% gain on your money. Yes, there was dips in the road. There was COVID. There was when the Federal Reserve raised interest rates. There was a Japan carry trade up here. But you guys got to understand that dips in the road are necessary and they happen all the time. So if we zoom in on the chart and go to a 6-month chart, you can see the VOO peaked around $519 a share. Then it took a dip to $475, then it went back up, then it's going back down. But all these short-term moves, it's all just noise in the big picture. I mean, look at this. This is a chart since 2010. If you would have made one investment in 2010 and forgot about it, if you would have put $10,000 in the S&P 500 in 2010, you would have bought in at $100 a share, and now it's $500 a share. You would have turned $10,000 into over $50,000 because I'm not even accounting for dividends that would have got reinvested. You would have 5x your money by not listening to anybody. You wouldn't have to do anything. You don't have to read company earnings reports. You don't have to read news articles. You do nothing. You just set it and you forget it. But the problem is there's all these people on CNBC, Yahoo Finance that try to trick you into having to subscribe to them to pay them money. You know, Jim Cramer charges $300 a month for his Action Alerts Plus. So I have subscribed to that before, and the first thing that I asked when I got into that platform is, you beat the S&P 500 after fees on a 10-year period. They won't tell you the information because they know that they don't beat the S&P 500. So if you have Jim Cramer, who has a TV show, Mad Money, every single day coming out telling you what to do in a stock market, but he doesn't beat the S&P 500, what value does he serve? He has no value. What is the point of learning all that information, stressing yourself out, when you don't even beat the average market return? I'm going to show you my average return that I've done since I started, because I went from $0 to $1.5 million in 5 years. I think that most of you guys can reproduce my results. I'm going to hop into that in just a second, but I want to hit on this for just a little bit longer. So I'm going to dive into a very important example for you guys to show you the number one thing that actually moves the price of stocks in the long run. It never fails. It's the number one indicator that matters. And then I'm going to go into my portfolio and show you how I went from $0 to $1.5 million in the last 5 years. So here we go. So this right here corresponds to the S&P 500 earnings growth. So this is a date on the left-hand side, and on the right-hand side, this is the earnings growth percentage per year. So what I'm going to do is add up all these percentages, and then we're going to go to the S&P 500 chart and see exactly what it did. So all these numbers right here I just added up, and it came out to a total earnings growth of 123% in this roughly 10-year period. So now I'm going to set up a chart and show you exactly what the S&P 500 did in that exact time frame. So this right here is a chart of the S&P 500 from the exact same date range, 2014 to 2024, same exact months, and you could go all the way to the right hand side, and you can see it went up 151% total. So 151%, and we have 123% right here of earnings growth. So what that means is the stock market, in my opinion, is a little bit overvalued as compared to the earnings growth. So when we added all this up, it equaled 123%, but the market went up 153%. So that's why I think the market's a little bit overvalued. So this red line right here correlates to the earnings growth of the S&P 500. So this is the average earnings growth of the S&P 500. Remember, it was about 123%. So I put it at 123% in that same exact time period. And you could see all this stuff over here. I think that the market is a little bit overvalued. So I'm going to flip it to a price chart so that we could see where the S&P 500 might be at. So up here we're at about $463 on the VOO. You know, the VOO can fall to about $425, and that'll be right there in line with the earnings growth. Now remember, it doesn't have to go straight in line with the earnings growth. You could see all through this period it was under the trend line, then it dipped hard during COVID, then it went up, so it's overvalued in this time period, and then it trends down and it goes up and down. But overall, when you zoom out, it's going to go above and below this line in the long run. So right now I told you guys that I'm not super bullish, I'm just kind of neutral, because I feel like the market is a little bit overvalued, so I'm not really making any big plays right now. And I also said I'm not really selling put options, I'm not really buying call options, I'm just kind of sitting on my hands waiting for a better entry price. But all those shares that I'm sitting on straight up, I'm not going to go out there and sell the shares and wait for a crash to happen and try to buy lower, because just look, what if I would have sold right here when the S&P 500 went a little bit into overvalued territory? I would have missed out on this entire upside right here, plus dividends through this whole time period. So the thing about it is, you know, I'm not going to go out there and sell everything that I have open right now, because just because the S&P goes up above the earnings growth line, it doesn't mean that you should sell right away. The problem is you don't know how long the market's going to go up. You know, it went up for another year after it went above the earnings growth line, and then it came down and it did a correction. This right here is when Jerome Powell started raising interest rates, so the market got scared. And then it's just kind of bouncing around with a lot of volatility. But now, you know, the market went up. So what if I would have got out right here? I would have missed all this upside. And there's a chance that the market's going to come down somewhere to this right-hand side over here, but I don't know for certain. But what I do know for certain is when you zoom out, this red line is going to be way up here to the right if we could extend this chart way outside off the side of the camera screen. And that's what you need to understand. So the key to the market is when you feel like the market is overvalued, you don't want to go heavy on options because you could get wiped out. But when the market is undervalued in this time period right here, which is when I sold a lot of puts and I bought a lot of calls and I bought a crap ton of shares straight up, once we received this upside right here, I made a ton of money. Now if that comes down, you know, half of this upside right here, it's not a big deal. So just to hit on one more quick thing on that, and then I'm going to show you what I did to make $1.5 million in 5 years. It's this thing called the rubber band theory, and it's really changed my life. So how the rubber band theory works is, for example, if earnings growth averages 10% a year for a 10-year period, in simple terms, let's just say that's a 100% earnings growth. But on the 10th year, if the stock market goes up 150%, it appears to be a little bit overvalued because the stock price outran the earnings growth. But if the earnings growth was 100% and the stock only went up 50%, you could say that the stock appears to be undervalued relative to the earnings growth. So if earnings growth goes up 10% a year, but the stock is down here, you take a rubber band and you stretch it down, and when you want to release the rubber band, the stock wants to fling back up to the mean line, and it works in reverse. If you pull the stock price up too high and you fling it and let it go down, the stock wants to go back to that mean line. So the more that stocks go above the mean line, the more likely they are to correct to the downside. Now it could go from above the mean line to below the mean line, and it's just a rubber band bouncing up and down, and that's just a lot of volatility. And that's kind of like what we're having right now. But overall, you know, especially in COVID, the rubber band got stretched down so hard and so quick during COVID that when the market was ready to bounce back, it was like ping, and it bounced straight up. Just like what happened with the Japan carry trade. The market, like a month ago, it went down 15%. It went straight down, stretching a rubber band very tightly down. Ping, you let it go and it bounces right back up. So more often than not, the best days in the market are often after the worst days in the market. So that's why I always preach that time in the market is more important than timing the market. So this is pretty much the strategy that I've been doing for the last 5 years. I've been buying into the S&P 500, buying into Triple Q all the time, and when I feel like the market's undervalued, I'll sell put options and I'll buy call options with usually like a 1-year expiration date. I like 1 year because remember, the longer that you stay invested, the more that this trend line goes up and the more that the market wants to follow that trend line. But if you go on these short-term moves right here, it's hard to know what's going to happen in a short little blip right here. But the longer you hold, you go from here to here. That captured a move. Maybe it's cheap through here, overvalued here, a little cheap here, maybe we're a little bit overvalued here. So that's kind of how I feel about this stuff. And if you guys do this year over year over year, you will make a lot of money. So there's a couple really big things happening with the Investing with Brandon platform. I'm working on a course for real estate and stocks. I'm going to break down everything that you need to know in a one-stop shop. I've been to plenty of seminars. I went through plenty of other courses. I read hundreds of books. I went from 0 to 1.5 million in 5 years. So that course is going to drop in roughly a month. I recommend everybody check that out because the information that's going to be in that is going to be priceless, and I can pretty much guarantee you that it's going to change your life. So after the course drops, you're going to have access to me every single day still if you have any questions. I'm going to make an exclusive Discord for course members only where you guys can ask your questions and I'll go in there and help you guys out. If you want to see some really good videos on how I trade stock options, there's a link below for that, and also my Discord link is going to be below. So like, subscribe, I'll see you guys later.